January 21, 1980. The trading floor of the commodity exchange in New York erupts in chaos. Silver, the metal that has backed currency for 5,000 years, has just touched $50 an ounce. 1 year earlier, it traded at $6. In a corner office high above Wall Street, Nelson Bunker Hunt and his brother William Herbert Hunt watched their fortune expand by $40 million every single day. The sons of the richest man in American history now control more silver than exists in the entire strategic reserve of the United States government. They own 192 million ounces of physical metal and paper contracts for another 90 million more. At this moment, the Hunt brothers possess nearly half the world's deliverable silver supply, and the global financial system is about to learn what happens when markets stop being abstract mathematics and become tangible objects that two men can fit inside warehouses. This is not a story about greed, though greed plays its part. This is not a story about folly, though the folly becomes apparent. This is a story about the fundamental tension at the heart of modern finance, the belief that markets exist in an infinite space where positions can grow forever, colliding with the physical reality that some things actually exist in finite quantities on planet Earth. The Hunt brothers did not invent the corner. Cornelius Vanderbilt cornered railroads. Jay Gould cornered gold. The Sumanotto copper trader known as Mr. 5% cornered copper. But the Hunts cornered silver at a moment when the global economy had just abandoned precious metals as the foundation of currency, when institutions believed they had transcended the old limitations, when computer terminals made traders forget that somewhere, actual metal had to actually exist. The Hunt brothers reminded the world that markets are not infinite. And the reminder nearly destroyed the financial system. The paradox is this: the Hunt brothers were right. They understood that governments were printing money backed by nothing but faith. They understood that inflation would ravage the value of paper currency. They understood that tangible assets would preserve wealth when confidence collapsed. They made every correct analysis about the monetary crisis of the 1970s. And yet their very correctness, pursued with absolute conviction and unlimited capital, became the mechanism of their destruction. This is the story of how being right can be more dangerous than being wrong. To understand how two brothers from Texas nearly broke the global economy, you must first understand what their father built. Haroldson Lafayette Hunt struck oil in East Texas in 1930 and transformed himself into the wealthiest private citizen in the world. When he died in 1974, his fortune exceeded $7 billion in an era when $1 billion meant something. His sons inherited not just wealth, but a particular worldview, deep suspicion of government, absolute faith in tangible assets, and the conviction that the American monetary system was approaching catastrophe. They were not entirely wrong to think this. The world these brothers inherited was unraveling. On August 15, 1971, President Richard Nixon appeared on television and announced that the United States would no longer convert dollars to gold at $35 per ounce. The Bretton Woods system, which had governed global currency exchange since 1944, collapsed overnight. For the first time in modern history, the world as reserve currency was backed by nothing but the full faith and credit of the United States government. The Hunts watched the purchasing power of the dollar decline 27% between 1972 and 1975. They watched oil prices quadruple. They watched gold surge from $35 to $200 an ounce. And they concluded that the entire monetary system was a confidence game about to end badly. Bunker Hunt was not a sophisticated financier. He was a gambler who raised racehorses and an oilman who trusted tangible things he could see and touch. His brother Herbert was quieter, more methodical, but shared the same fundamental distrust of paper assets. Together, they began accumulating silver in 1973. Buying futures contracts and taking physical delivery of the metal. This strategy made sense in an inflationary environment. Silver had industrial uses in photography, electronics, and medicine. It had monetary history spanning millennia. And unlike gold, which governments hoarded, silver seemed overlooked, undervalued, trading at less than $3 an ounce. The brothers were not alone in this analysis. Saudi investors, watching the purchasing power of their oil revenues erode, joined the Hunts in 1979. Together, they formed a loose confederation that would become known as the Silver Pool, coordinating purchases across multiple entities to avoid triggering regulatory scrutiny. This was the critical mutation. What began as a value investment transformed into something else entirely. a deliberate attempt to control a significant portion of the world as above-ground silver supply. The Hunts had discovered the same fundamental truth that Vanderbilt and Gould understood a century earlier. If you control the physical commodity and simultaneously hold contracts requiring delivery of that commodity, you can name your price. The corner was on. The mechanism of a market corner is elegantly simple and brutally effective. Imagine you and I make a contract. I promise to deliver to you 100 ounces of silver on December 31st at a price of $10 per ounce. You do not actually want silver. You are a speculator betting that silver prices will fall, planning to buy the metal at $6 and deliver it to me at $10, pocketing the difference. This works perfectly in a normal market where silver is widely available. But now imagine I have spent the past year quietly buying every available ounce of silver I can find. December 31st arrives. You need 100 ounces to fulfill our contract. But I own the supply. I will sell you silver, certainly, but the price is no longer $10. The price is whatever I say it is, because you have no choice but to pay. You are caught in the corner. This is what the Hunt brothers constructed between 1979 and 1980, but on a scale that made previous corners look quaint. By early 1979, they held 63 million ounces of physical silver. They placed this metal in warehouses in Chicago, New York, and Zurich, removing it from the available supply. Simultaneously, they purchased futures contracts requiring delivery of 90 million additional ounces. As long as they could continue taking delivery and paying the escalating storage costs, they controlled the price. Every speculator who had sold silver short, betting on price declines, now faced the Hunt brothers on the other side of the trade. And the Hunts had the metal. Silver began its ascent. $6 in January 1979, $8 in September, $16 in December. The Hunts borrowed against their silver holdings to buy more silver, a feedback loop of leverage that accelerated the price surge. The Commodity Futures Trading Commission, established just 5 years earlier in response to previous commodity manipulation scandals, watched nervously but took no decisive action. The regulatory framework for modern commodity markets assumed a world where no single entity would or could corner a significant portion of the major market. The Hunts revealed this assumption as dangerously naive. Compare this to the most infamous corner in American history, Jay Gould and James Fisk's attempted gold corner of 1869. Gould, understanding that the U.S. Treasury controlled vast gold reserves, sought to prevent government gold sales by compromising President Grant's brother-in-law. When Grant discovered the scheme and ordered Treasury gold sales, the corner collapsed in a single day known as Black Friday. The Hunt brothers had studied this history. Their advantage was that silver, unlike gold in 1869, had no massive government stockpile waiting to flood the market. The U.S. Strategic Silver Reserve had been depleted by 1970. The Hunts appeared to have found the perfect corner, a commodity with genuine demand, limited supply, and no government entity capable of breaking their grip. But examine the human cost unfolding beneath the price charts. By January 1980, silver's surge to $50 per ounce created chaos in every industry dependent on the metal. Kodak, the photographic giant, saw its costs explode as silver formed the essential substrate for photographic film. Tiffany & Co. took out full-page newspaper advertisements, condemning the Hunt brothers for destroying the silverware and jewelry markets. Small manufacturers went bankrupt, unable to afford raw materials that had increased 800% in 12 months. The Hunts, focused on financial markets and vindication of their monetary theories, seemed genuinely surprised that their corner had real-world consequences for actual human beings trying to conduct actual business. The pattern repeats through history with remarkable consistency. In 1996, a copper trader named Yasuo Hamanaka, working for Sumitomo Corporation, attempted to corner the global copper market and succeeded for nearly a decade before the position collapsed, costing his firm $3.7 billion. In 2008, a Lehman Brothers trader attempted to corner the lithium market just weeks before the firm collapsed. In each case, the trader believed they had found a commodity with constrained supply and growing demand. In each case, they confused market dominance with market control. In each case, they discovered that prices pushed beyond fundamental value create their own destruction. The Hunts pushed prices beyond any fundamental justification. $50 per ounce valued silver higher, in inflation-adjusted terms, than at any point in recorded history. This price bore no relationship to industrial demand or monetary utility. The price existed solely because the Hunt brothers willed it to exist, backed by billions of dollars in borrowed capital. They had created what economists call a self-referential asset bubble. The silver was valuable because the Hunts said it was valuable. The Hunts could afford to say it was valuable because the silver kept rising, allowing them to borrow more money against their holdings. As long as confidence persisted, the loop was self-sustaining. But confidence, as the global economy learned in 1929 and 2008 and will learn again, is never permanent. The corner began to crack on January 7, 1980, when the Commodity Exchange implemented Silver Rule 7. This emergency measure limited speculative positions and increased margin requirements, forcing traders to deposit more cash to maintain their futures positions. The Hunts, leveraged to the limit of their vast fortune, suddenly faced a choice: deposit billions in additional margin or begin liquidating positions. They chose to hold, confident that silver's rise would continue, convinced their analysis of monetary collapse was correct. They miscalculated fatally. They had confused being correct about inflation with being able to control markets indefinitely. Through January, silver remained above $40. But the momentum had shifted. New supply emerged as ordinary citizens melted down family silverware, transforming wedding gifts and heirlooms into $40 per ounce commodity. The Hunts had not anticipated this response. Their corner assumed a static supply. But high prices create their own supply. And $50 silver meant that millions of Americans suddenly possessed wealth in their dining rooms worth more as scrap metal than as functioning objects. Refineries worked triple shifts. The trickle became a flood. March 1980 arrived with silver still above $35. But the futures exchanges implemented another rule change. They increased margin requirements again and limited the number of contracts any single entity could hold. The Hunts, who had used borrowed money to purchase their positions, now faced margin calls totaling hundreds of millions of dollars. On March 25, silver prices fell to $10.80 per ounce. In a single day. The collapse happened so fast that trading had to be halted 3 times. By March 27, Silver Thursday, the Hunt brothers could not meet their margin calls. They defaulted on debts exceeding $1.7 billion. The cascade of March 27, 1980, revealed how deeply the Hunt silver corner had penetrated the financial system. Batch Halsey Stewart Shields, the brokerage that had enabled much of the Hunt brothers' trading, faced insolvency. If Batch failed, it would trigger failures at other brokerages holding positions in silver futures. If the futures exchanges collapsed, confidence in commodity markets would evaporate. If commodity markets failed, the credit system that depended on those markets for price discovery would fracture. The Federal Reserve, the same institution the Hunts had spent years denouncing, assembled an emergency consortium of banks to provide a $1.1 billion bailout. The Hunt brothers, who had built their fortune condemning government intervention in markets, were saved by the very intervention they despised. The human cost played out in obscurity, uncounted in the headlines. Small jewelry manufacturers who had hedged their silver purchases with futures contracts discovered their hedges had vaporized when the exchanges changed the rules mid-game. Workers lost jobs as Kodak and other silver-dependent industries restructured. The elderly couple who had melted down their wedding silverware at $40 per ounce watched the market stabilize at $10, realizing they had exchanged family history for a loss. The Hunt brothers lost billions but remained wealthy men. The ordinary participants in the silver markets they distorted did not have billions to lose. Compare this to the collapse of long-term capital management in 1998, when a hedge fund employing Nobel Prize-winning economists nearly destroyed the global financial system through excessive leverage and correlated bets. Or examine the Metal-Gesellschaft crisis of 1993, when a German conglomerate lost $1.3 billion attempting to hedge oil positions, requiring government intervention to prevent broader market failure. The pattern is identical: sophisticated actors using complex strategies and massive leverage, convinced their analysis is correct, discovering that markets can remain irrational longer than you can remain solvent, requiring government rescue to prevent systemic collapse. The specific commodity changes. The mechanism does not. The lesson the Hunt brothers taught was not the lesson they intended to teach. They wanted to demonstrate that government-issued currency was worthless paper, bet only tangible assets had real value, that the system was corrupt and doomed. They were partially correct about inflation and monetary instability. But their attempted corner revealed a deeper truth. Markets are not merely abstract systems of price discovery. They are social technologies requiring confidence, rules, and restraint. When participants attempt to treat markets as conquerable territory, as physical domains that can be owned outright, the market itself becomes unstable. The Hunt brothers believed they could escape the fiat currency system by accumulating the ultimate tangible asset. Instead, they discovered that silver's value was itself a social construction, dependent on collective agreement and market confidence. At $50 per ounce, silver was worth $50 only because participants believed it was worth $50. When that belief collapsed, no amount of physical metal in Hunt-controlled warehouses could sustain the price. They had tried to build wealth outside the system while using the system's tools: borrowed money, futures contracts, margin accounts. You cannot escape fiat currency by using fiat currency to purchase alternatives. The philosophical weight of this failure extends beyond finance into questions of value itself. What is wealth? The Hunt brothers accumulated 192 million ounces of silver, a physical substance that had been valued for 5,000 years. Yet this accumulation, pursued with perfect logic and supported by reasonable economic analysis, destroyed rather than preserved their wealth. They had confused the symbol with the thing itself, forgotten that even precious metals have value only because humans collectively agree to assign them value. When they pushed silver to artificial heights, they broke the collective agreement, and the value vanished. This pattern appears throughout economic history with the regularity of a mathematical proof. The Dutch tulip mania of 1637 ended when participants realized tulip bulbs, regardless of scarcity or beauty, could not sustain prices equivalent to Amsterdam townhouses. The Mississippi bubble of 1720 collapsed when French investors understood that shares in unexplored Louisiana wilderness should not be worth more than the entire French economy. The railway mania of 1840s Britain burst when the number of proposed railway lines exceeded any possible use for railway transport. In each case, a genuine innovation or genuine scarcity became a vehicle for speculation that detached price from fundamental value. In each case, confident investors believed this time is different. In each case, physics reasserted itself and prices returned to earth. The Hunt brothers returned to Texas, their fortune diminished but not destroyed. Bunker Hunt, when asked if he had learned anything from the silver crisis, replied, "Yes, I learned that the government can change the rules whenever they want." He never grasped the deeper lesson. The rules changed not because of government conspiracy, but because his own actions threatened to destroy the market as basic functioning. Markets require losers and winners to remain liquid. A corner eliminates losers' ability to exit, transforming the market into a hostage situation. The exchanges changed the rules because the alternative was market death. Silver stabilized around $10 per ounce through the 1980s, then declined to $4 by 2001 as digital photography reduced industrial demand. The metal the Hunts had valued as eternal wealth proved vulnerable to technological obsolescence. By 2011, silver had recovered to $48 briefly, driven by new speculative fervor before collapsing again to $15. The pattern continues because the pattern is structural, embedded in how humans interact with markets and scarcity and faith. Stand for a moment in the warehouse where the Hunt brothers stored their silver. Imagine 192 million ounces stacked on pallets, metal bars stamped with purity ratings and serial numbers. This is tangible wealth, the kind you can touch and weigh and secure behind locked doors. Now understand that this tangibility was always illusion. The wealth existed not in the metal, but in the collective human agreement that metal was valuable. When the Hunt brothers broke that agreement through their corner, they discovered what every market manipulator eventually learns. You cannot own collective belief. You can only participate in it, or destroy it. The markets opened the next morning. Silver traded. The system survived. And somewhere, two brothers from Texas learned that there are things more powerful than oil fortunes and family dynasties, and 192 million ounces of precious metal. The thing more powerful is the simple fact that markets exist in the realm of shared human belief, and belief cannot be cornered, only lost.